Hi, this is tax attorney John Hyre. It is February the 5th of 2023, and we're going to do a review of the Secure Act 2.0. I'm a tax attorney and accountant. I've been practicing for 27 years. Most of my clients are real estate investors, self-directed IRA and 401k holders, small businesses, high net worth individuals, that whole genre. You guys are so ADD that you can't help yourselves. You actually end up doing a great number of things. But I do quite a lot, include litigate self-directed 401k, self-directed IRA issues. So of course, the Secure Act is of importance to me. I give a lot of classes and presentations. Unlike this one, I charge for most of them. And if you're interested, take a look at taxreductionlawyer.com. We do them both online and in Puerto Rico, where I am now. I'm actually at home, as you can probably tell by the background. The office has a bit of noise because Old San Juan on a Sunday, you're going to have noise. Why do I live in Puerto Rico? Well, a number of reasons, but towards the top of the list would be taxes. My tax rate is about, I'd say 6% total. I don't pay US federal income tax. I just pay local tax. And so it certainly has its benefits. Add a little bit of sun, beaches, noise, sometimes good, noise, sometimes bad, etc., and it's a living. So on we go to Secure Act 2.0. We have to give the usual disclaimers. This is education. This is not legal advice. I don't know your individual facts and circumstances, and even when we do the question and answer session, which we shall, it's still educational to know enough about you to give legal advice. Two things have to happen. I have to take a look at your individual personal information, and that's not something I'll be doing during even the Q&A session. And second, I need little green pieces of paper, about 1,000 of them per hour. So until that happens, it's not legal advice. It is good education. If you try any of it without an actual tax professional helping you out, you're probably going to win a financial Darwin Award, lose a bunch of money, and well, you were warned, so I'm not liable. Really, people, talk to a competent professional before you implement. And also in our new modern age, we have to give trigger warnings. So just in case you missed it, I am not sensitive. I am not politically correct. I am most certainly not woke. You should consider this your trigger warning. I will say mean, hurtful things, at least if you are overly sensitive, artificially sensitive, or worst of all, artificially overly sensitive. For you people, and I think you know who you are, this isn't for you. Cancel away, or go get your information from someone else more palatable. On we go. My purposes and biases in giving this presentation. I deal a lot with self-directed IRAs and 401ks and small to medium-sized businesses. So this really is going to, the Secure Act is huge. There's just a ton of information in there. Much of it doesn't apply to you, particularly not directly. A lot of it applies to odd circumstances, large companies, the corporate world, really just the tax geeks who are involved with running so-called regular 401ks. So my focus is going to be self-directed accounts for small to medium-sized businesses. Also, part of what influenced my presentation, 401ks for self-direction are the superior account. I don't spend a lot of time on simples. I don't spend a lot of time on SEPs because 401ks are superior. And I listed a few. There are more, but I listed a few of the reasons why 401ks are superior. The prohibited transaction penalties, which are always a risk. We try to minimize it, but it's a risk when we're doing self-directed investing. Those penalties are lighter in a 401k, including a solo K. Also, there is a special tax that applies to retirement accounts, UBIT, unrelated business income tax, and exactly the same rules apply to 401ks as do to IRAs and other accounts. Exactly the same rules. Some of you mistakenly think 401ks are exempt from UBIT. That is not correct. Rather, 401ks have a narrow but important exception to UBIT. Specifically, one of the things that triggers, oh, there's that word again, one of the things that triggers UBIT would be borrowing. If a retirement account borrows money, the borrowed money's profits are taxable. Now, there are formulas and a lot more complexity to it, but that's the gist. If your retirement account borrows money, the profit generated by the borrowed money is taxable. That's one of several different things that can cause UBIT. In a 401k, there's an exception. If you borrow to acquire or improve real estate. And there are more bells and whistles and requirements, I'm generalizing. But if you borrow to improve or acquire real estate in a 401k, there is no yield. But if you do the same thing in an IRA, a SEP, or a simple, there is UBIT. So consequently, I think 401ks are the superior account. In fact, if you have pre-tax traditional money in any other account, and if it's possible, I would roll it to a self-directed 401k. Now, you cannot roll Roth IRA money into a Roth 401k simply because the rules say you cannot. Likewise, you cannot roll traditional after-tax money from an IRA, for example, to a 401k. Rather, it behooves you to convert that to a Roth, also known as the backdoor Roth, after you roll the traditional pre-tax money to your 401k. And finally, I could go always, because with taxes are always strings attached and lots of details, I could go into far more detail than I plan to do, but really this presentation is for normies and not for accountants. I will go into some detail, but I want to keep this palatable and presentable, so I'm not going to go hopefully into excessive detail. So for self-directed IRA investors, and I'm going to use IRA generically unless I'm being very specific on a slide. It's a lot easier to say just IRA instead of self-directed IRA, 401k, SEP, simple, HSA, Coverdale. So I'm going to use very general terminology. Prohibited transactions when self-directing are probably your number one concern. So what happened in this bill with prohibited transactions? For me, I mean, if you have a prohibited transaction in an IRA, an HSA, a Coverdale, a SEP, or a simple, if you caused it or a beneficiary of the account caused it, the entire account dies. Now in 401ks, the penalty is much, much lower. It's one reason I like 401ks. It's only 15% of the transaction. So we pay very, very close attention to prohibited transactions. It's something I speak on and teach about frequently, because if you mess it up, things go very poorly. We had a nasty surprise. I mean, the Secure Act was good overall. There's very little that was added that I did not like. There were some things that were in it that were taken out at the last minute. That was a shame because they were good things. And there were a lot of things that could have been in it that were really bad that never appeared. So overall, the Secure Act 2.0 is a good thing, but there were a few things removed. Prohibited transactions, as an example, in the House version, what they said was if your IRA had a prohibited transaction, only the transaction amount would be distributed. So for example, I have $1 million IRA, I lend my mother $1, only the dollar would be distributed. That would have been nice. That would have been an improvement. Under present rules, and unfortunately, post Secure Act 2.0 rules, IRAs and similar accounts, HSAs, Coverdales, SEPs, simples that have a prohibited transaction, the entire account is distributed and penalized. You're basically looking at about a 60% loss, and the remaining 40% no longer being tax deferred or tax free. So the House version would have reduced the penalty greatly. The Senate version simply would have applied the 401k rules, which I like even better, to the IRAs, saying that, listen, whatever the transaction amount was, we're going to tax 15% of it, but we're not going to distribute the whole amount. So for example, the rule today in a 401k, and would have been nice had it changed for IRAs, but it didn't. The rule today for 401ks, if I lend mom $1, I have a 15-cent per year penalty, a lot less, right? That's one of the reasons I like 401ks, the lower penalty amounts for prohibited transactions. At the very last minute, they changed the statute. I would have taken either the House version or the Senate version. They changed the statute and simply said, well, we're going to clarify that when you have a prohibited transaction, only that particular account is destroyed, only that particular account. So we thought that was the law. It was nice of them to clarify it. And I suppose what that means for us is that when we're doing things that are risky when it comes to prohibited transactions, perhaps we're managing rentals directly, we don't have a management company for IRA-owned rentals. We do the work ourselves as a manager, or we act as a general contractor on rehabs, to give two examples. Is that a service? Well, we don't know. There's no law on it yet. But if it is a service, then you've got a prohibited transaction. So if you're doing things like that, that down the road, tax court or IRS could say, you know what, we think that's a prohibited transaction. you really want to separate those activities from other activities so that the only IRA that gets hit is the one that has the risky transaction. So for example, if you're landlording pretty hands-on in your IRA, you're also doing lending. I would have the lending in a separate IRA account so that if for any reason something happens to the rental account, you don't blow the lending account. So there were a lot of things that were not in here. No ability to convert Roth IRA to Roth 401k. Again, that was in the original bill, which would have been nice because since I think 401ks are superior to IRAs, I would have liked to have seen the ability to convert Roth IRAs to Roth 401ks. That was taken out at the last minute. Now, the good news, if you take a look at the final bullet point, for those of you who remember, there was a movement to try and essentially make self-directed IRA investing very, very difficult. It wasn't a direct ban. Let's say it was an indirect ban, for example, by requiring appraisals for most transactions, banning checkbook LLCs, et cetera. Self-directed IRA investing would have been, as a functional matter, probably dropped to about 5 to 10% of where it's at now. Thankfully, none of those prior proposed changes from Build Back Better made their way back into this bill. And the reason for that is a lot of people, including your custodian, lobbied heavily and asked you to make a lot of noise and send a lot of letters, a lot of emails. We had done this with handsoffmyira.com, and that site's still out there. Hopefully we don't need it again. But we actually did get feedback from Congress that all the letters, emails, and faxes that you sent were received. And please stop sending them. We're not going to take away your self-directed IRA. Granted, we don't really trust any of them, so we keep an eye open. Bottom line is this: there were prior proposed changes in Build Back Better. They were very, very bad. None of them made it into this bill. I was very happy to see that. All right, RMD is a required minimum distribution. Once you hit a certain age in anything but a Roth IRA, once you hit a certain age, any account except a Roth IRA is required to start making distributions. And I won't go into the mathematics. There are charts, and it has to do with life expectancy and so forth. But you're required to start taking money out of all these other accounts. Now, we have a very nice change here. Starting in 2024, Roth 401ks are no longer required to make required minimum distributions. So in this regard, they're going to have parity with Roth IRAs, no RMDs or required minimum distributions from 2024 onward. And so this is great because, again, I favor 401ks. What was one reason we would see people roll from a Roth 401k to a Roth IRA? Well, under the rules that are in existence till the end of 2023, Roth 401ks, just like any traditional account, had to make RMDs. So when people were old enough, depending on when you were born, 70 and a half, 72 or 75 years of age, once you hit one of those trigger ages, you had to start distributing. So to avoid that, people would roll from their Roth 401k to their Roth IRA. That is no longer necessary. And by the way, does it cover existing Roth 401k plans that are already making required minimum distributions? It does. So existing 401ks where the owner is old enough that they have to make distributions from their Roth 401k starting in 2024 will no longer have to make distributions. There's a system in place called EPCRS. It does not apply to IRAs, but it shall in 2 years. EPCRS, Employer Plans Compliance Resolution System, is a way to fix mistakes in retirement plans, but it really doesn't apply to IRAs. What Congress said here is, well, we want this to apply to IRAs and IRS. You have 2 years to implement regulations. Now, look, the worst case is we get something tepid and weak, which is, by the way, what I predict, because the present EPCRS is really not all that much to write home about. Yes, it provides you with some extra opportunities to fix issues in 401ks, such as failure to make required minimum distributions. But the existing system isn't really that great without going into detail. It's great that they gave us extra options. We just find that given the hassle and how narrow the exceptions are, we don't use it very frequently. So I don't expect they'll do any better for IRAs. So is this going to cause problems or hurt us other than adding extra law we have to know and read? No. Am I hopeful that once they issue regulations, assuming they actually do so, because oftentimes Treasury ignores Congress and says they're too busy to issue regulations on time, am I hopeful that the regulations are going to have magical, wonderful things? No. I mean, it would be great, for example, if they were to issue a way to correct prohibited transactions and reduce or eliminate the penalty as long as one corrects the prohibited transaction. That would be the holy grail. Will we see it? I'm betting not. I'd love to be wrong. Required minimum distributions start later. So they're changing the age. If you remember, it used to be 70 and a half when these started. And then the law changed with Secure Act 1.0, at least for certain people, depending on birth date, to 72 years of age. Well, now they're changing it depending on when you were born to 73 or 75. And really, the blue highlighted text gives you the basic rule. If you were born in 1951 to 1959, the trigger age for required minimum distributions is now 73 instead of 72. If you were born in 1960 or later, the required minimum distribution age will be 75. Now, there is a drafting issue. This was poorly drafted. So 1959 is unclear. We don't know if they meant from 1959, people born in that year, to have to do required minimum distributions at age 73 or at age 75. So what happened if you turned 72 in 2022? Well, the normal RMD rules apply. In other words, in 2023, you still have to do RMDs because you hit 72 back in 2022. On the other hand, if you hit 72 in 2023, you clearly do not have to start with required minimum distributions for another year. In other words, until you hit 73. Now, for the rest of you who are under that age group, this is good to know. And yay, it's a good thing. They're giving you the option to wait longer before you're required to make distributions. That's a good thing. More options are good. Required minimum distributions have very high penalties for the failure to make them. So be aware of this. Again, it's just for future planning. If you don't make the required minimum distributions, the penalty is 50% of the amount you failed to distribute per year. It's a huge penalty. Think about it. It's 50% of the amount you failed to distribute per year. I think the example lays it out rather well. An RMD of $20,000 should have been issued by December 31st of 21. Only 5,000 was actually issued, so you were short 15,000. That's the shortage. Well, what's the tax? It's going to be 50% of the 15,000 or $7,500, and that's just for 1 year. So you don't want to miss your RMDs. You want to make sure they're calculated correctly, distributed on time, make sure there's enough liquidity in the account to actually do that. Now, the penalty is reduced 2023 onward. It's only a 25% penalty, and in some cases, only 10%. So that's good. I think still you want to take the path of let's not have a failure in this regard. Once it's time to make required minimum distributions, let's make sure that gets done properly and timely. All right, statute of limitations, SOL, for some of you stands for something else. Here, we're going to be not naughty. We're going to be nice. It stands for the statute of limitations, which means the amount of time the IRS has to audit you. The shorter the statute of limitations, the better. The sooner you start it normally, the better. So as soon as the statute, let's say the statute of limitations is 3 years, which is usually the case with tax matters, sometimes 6 years. The statute of limitations starts for your 1040, for example, on April 15th, or the day you file your 1040, whichever's earlier. So there's no benefit to filing the 1040 before April 15th. It actually gives the IRS extra time to audit you. So you might want to prepare the filing before April 15th, but because the statute starts April 15th, or when you file, whichever's later, you probably want to extend and file just a touch after the 15th or prepare the return and have it turned in. That way, the clock starts ticking, and the IRS, depending with the 1040, has 3 to 6 years to audit you. The sooner you start the clock ticking, the sooner it runs, the sooner their time to audit you runs. Now, required minimum distributions, which we described, the statute of limitations did not used to start until you filed a specific form called a 5329. So if you filed RMDs, you had to file a 5329. And if you didn't, the statute of limitations never started. That meant that the IRS could audit RMD failures into infinity. They could destroy your account. I mean, if you look at the failure to distribute at a 50% penalty, now 25%, and the statute never started, they could audit as many years as they wanted. Once they found a failure, they could just go back in time, hit you every year until they took as much as they wanted to. So Congress said, you know what, we're going to change this, because nobody, who ever heard of a 5329? Who actually attaches that to their 1040? Very few people. So Congress, recognizing that, said, listen, once you file your 1040, whether or not there's that form 5329, that starts the statute of limitations for the IRS to be able to audit required minimum distributions. And that's a much more sensible approach. Now, this is really important, what I'm about to mention, very important. Excess contributions. If you make an excess contribution to your IRA, right, the normal contribution limit for 2023, if you're under 50, is $6,500 per person. If you make contributions beyond that to your IRA, which, by the way, your custodian is not going to willingly let you do that. Your custodian won't just say, you call them up and say, listen, instead of 6,500, I'd like to put in $1 million this year. The custodian's not going to play ball. There are ways, we've structured this for clients where we do contribute an extra $1 million to an IRA. What's the goal? The object is, and don't try this at home, this is, I'm giving you the broad parameters. If you try it on your own, it's going to blow up in your face and you're going to lose a lot of money. But we have had clients with tiny IRAs, in particular Roths, where we'll have them contribute an extra $1 million. Now, what's the penalty for contributing the extra $1 million? 6% of the excess contribution for any part of the year it touches. So if I contribute the extra $1 million December 30th of 2023, that's 6% of $1 million, 60,000. I contributed at the end of 2023. My excise tax is $60,000. Obviously not a great idea. We have had clients that make an excess contribution of, let's say, $1 million to a very small Roth IRA. They do it, let's say, January 2nd of 2023. And maybe they keep the $1 million in there till the end of 2023 or the end of 2024. They double or triple the account. They pull out only the excess contribution, only the excess contribution. They leave all the income in there. Now, is it worth it? Let's say I double I had a $6,000 Roth IRA. I put in an extra $1 million. Let's say I do it for a year. I pay the $60,000, but I make $1 million in the year. So I pull out the original $1 million contribution. My Roth still has $1 million of earnings left in it. It now has $1,005,000. And the cost of that was $60,000. I had to pay the government a tax for having done that. Is that a good deal? That depends on you. That's a really subjective call. I must again reiterate, don't try this at home. We have structured it for clients. And no, I won't review your plans on how to do it. You're going to send me emails asking, is this how you do it? I'd like to hire you for an hour, spill the beans in an hour on how to do excess contributions of $1 million while only paying $60,000, because I do think generating an extra $1 million or $2 million in a year is a good idea. We do that. It's a fixed fee. It's not cheap. It's not entirely simple. But here's what's interesting. So what was the original purpose of the excess contribution rules? Let's say you had 2 custodians and you double contributed. You just weren't thinking, maybe you were, and you put $6,000 into the IRA with one custodian and $6,000 with another. And let's say the limit for that year was $6,000. You had a $6,000 excess contribution. Multiply that by 6%. What's that going to be? $36 tax, something along those lines. A very small tax, but they wanted to dissuade you from making excess contributions. And some people decided later on, you know what? Like, as I mentioned before, why don't we do this on purpose? In fact, we've started to have some case law on exactly these kinds of issues. And people were afraid that when taxpayers put in excess funds into their IRA, the IRS would try and do something else. And so far, what we've seen in the case laws, they just go after the 6% penalty. So what we figure is, well, just report it up front. So here's what gets interesting. The statute of limitations for an excess contribution, also like with RMDs, would not start to run. The clock didn't start to tick on the IRS audit period until you filed the 5329. That's where you report and pay the 6% excess contribution tax. So if you never filed it, and most people didn't because they didn't even know it existed, the statute of limitations would never start. So Congress said, well, we're going to go ahead and do the same thing with RMDs and excess contributions. The statute of limitations will start when you file your 1040. Except they gave us an exception, which is really interesting and revealing. Take a look at the blueprint. This is really interesting. If an excess contribution is in relation to the acquisition of property for less than its fair market value, then you need to file a form 5329 for the statute of limitations to start. In other words, we're going to go easy. We're going to say excess contributions, the statute of limitations start when you file the 1040. Unless you're using the money, the excess contribution, to acquire property for less than its fair market value inside the IRA, in which case you really need to file the 5329. Now that's very interesting because that sounds like a planning technique I've been talking about for about 10 years. Yeah, so interesting that they're acknowledging people make excess contributions in order to go pick up a bargain inside of their retirement account. They're acknowledging it. How are they acknowledging it? They're saying we're not going to ban it. You just have a different statute of limitations. You actually have to file the 5329. Now, isn't that interesting? It's implicitly acknowledging that people are going to do this and saying, we expect you to pay your 6%. Well, for some of you, that's an awfully good deal if properly done and properly structured. And as I mentioned, it's consistent with case law. For me, this is one of the most interesting slides in the entire presentation, that ability to make the excess contribution. Now, granted, you're paying the 6% no matter what. So if you make an excess contribution of, say, $1 million, which your custodian will not let you do directly, and let's say you lose money, you still owe the 6% to the government. It's not contingent on making money. So there is risk. This one has been hot in the press. They've mentioned this a lot. I'll bring it up. I simplified it in the first paragraph. I don't think it's that big a deal, but the financial press loves it and I think makes it into something much larger than it really is. Specifically, a 529 educational plan can be somewhat mildly rolled over to a Roth IRA. Let me give you my condensed version, and that's the first paragraph. Starting in 2024, you may roll a lifetime limit of $35,000, so it's not a whole lot. I mean, it's nice, but it's not a ton, of seasoned money and assets, and I'll explain what that means, from an old 529, I'll explain what that means, to the beneficiary of the 529, usually your child. Usually you set up a 529 plan for a child. And the idea here is if there's money left in the plan, under certain circumstances, we'll let you substitute money from the 529 for contributions to your Roth IRA. Let me repeat that. If you have a 529, it's been around for long enough, and the money that you're moving has been around for long enough, we will let you move money from the 529 into the beneficiary, usually the child for whom you set up the 529. We'll let you move money from the 529 into the Roth IRA, not as an addition, but as a substitute for normal annual contributions. Now let's walk through the bullet points. So the 529 must have been maintained for at least 15 years. That's what I mean by old. Only amounts that have been in the 529 plan for at least 5 years before the rollover date can be moved. That's what I mean by seasoned. Now, coincidentally, for you to distribute money from a Roth IRA, what has to happen? You have to be 59 and a half or older, and you have to have had a Roth IRA for at least 5 years, frequently known as the seasoning requirement. So what a coincidence. They want the money from the 529 to be seasoned. They want the 529 to be old. The rollover counts as a Roth IRA contribution for the year. So this is a substitution, not in addition to the normal contributions. You have to have compensation, right? We're not really teaching a basic class here, but as most of you know, sort of an intuitive way, you have to have W-2 or other income that qualifies as a really important word in retirement tax language, compensation, in order to contribute to plans. The most common example of lacking compensation would be your full-time landlords. Rental income is not considered to be compensation, and so it doesn't qualify you to contribute to a retirement plan. So here what they're saying in the third bullet point is the rollover counts as the Roth IRA contribution. It's not in addition to, it's instead of. You can't exceed the normal limit. For many of you, $6,500 a year. For some of you who are a little older, $7,500 a year. You have to have enough compensation. Now, the income limitation doesn't apply. Normally with Roth IRAs, if you make too much, roughly $200,000 married filing jointly, then you cannot directly contribute to a Roth IRA. You have to do a backdoor Roth IRA. And what they're saying here, that income limitation doesn't apply. So even if you make $300,000, as long as you have enough compensation and you've got an old seasoned 529 plan, you can then roll what would have been your contribution for the year from your salary or from your compensation. Instead, you can roll it from the 529 for that year. How much? $35,000 lifetime, and there's no indexing for inflation. So, okay, this isn't bad. It's okay, but it's not, if you look at the numbers and the magnitude of the numbers, it's not that big of a deal either. So you keep it in your bag of tricks, but I probably wouldn't really be writing home about it. Have another wee little sip. This is an important slide. For some of you, it will be review, and for some of you, it will be new. And you need to know this, especially if you have a solo 401k or any other kind of 401k. Most of you do not understand 401k contribution basics, but you need to. In order to understand some of the changes Secure 2.0 made, you need to understand how contributions to 401ks function. So I thought I would explain it. It's really easy. And in this slide, the example assumes you're under 50. If you're over 50, the amounts are larger. This slide talks about how you contribute to 401ks. First of all, it's easier if you look at the 401k as the bucket. And if you look at the third line, total contributions per 401k, without going into details, can you have and contribute to more than one 401k per year? Yeah, I've got clients who have, so far the record is 3 401ks that they can separately contribute to. If you look at the 401k as a bucket, the bucket can take up to 66,000 of contributions per year. Now that's a surprise to some of you. Some of you have been told you can only contribute 19,500 or some such number to your 401k per year. That's not really correct. So the 401k bucket for 2023, if you're under 50, is 66,000 per 401k. You may be able to have multiple 401ks. Now there are 3 basic contribution types. And if you look at each of them as a cup that you pour into the bucket up to when the bucket fills, you can always keep it at less, most people do, but you can fill the bucket, but you have 3 cups to pour it in. That the contributions make more sense that way. So the one you're all familiar with is number 1, in formal language, the elective deferral, and in normal language, the employee contribution. This is the part that's pulled out of your W-2 if you have a job or you have your own S or C corp that pays you a W-2. This is the part that's pulled out of the W-2 and goes into the retirement plan. So this is $22,500 per person. So it doesn't matter how many accounts you have. Cup number 1, if you're under 50, is $22,500 per person for 2023. And it uses up compensation. So for example, let's say I only have 10,000 of compensation. Can I use the whole cup number 1? No, I only have 10,000 of compensation. This cup is allowed to be up to 22,500. But if I only have 10 grand of compensation, well, it's the smaller of the limit for the cup or compensation. And this uses up compensation. So let me give you another example. Let's say you have I don't know, what would be a good example? Let's say you have 23,000 in salary, just for a simple example. So you make your number 1 election, your cup number 1, you use it up completely. So you had 23,000, you use up 22,500, you have $500 of compensation left to use. You used up 22,500. Why does that matter? Because other contributions rely upon your compensation, your salary. For example, your IRA. Well, now I can only put 500 in the IRA. Why? Well, because IRAs also use up compensation. But if you only had 23,000 and you used up 22,500 on your 401k, that just leaves you another 500 of compensation dependent contributions to make to another retirement plan, whether it's an IRA or a 401k. So you really have to do some planning, particularly if you're self-employed. How much compensation, that's a complicated discussion, that's a separate webinar. How much compensation should I generate? How much do I need to generate to fulfill my goals? So that's cup number one, but there are two more. Number two is the employer match. So the employer matches a percentage of every qualifying employee's compensation. For example, if you only worked 200 hours during the year, you're super part-time, the plan documents can say, well, people who work less than a certain number of hours, let's say 500, don't qualify. So employer matches a percentage of every qualifying employee's compensation. For most of you, W-2, but it could also be income, for example, from your Schedule C or from an LLC that you generate certain types of income in. The same percentage for all employees, up to 25%. Now, the normal way this has been done is that it's a traditional contribution by the employer. In other words, it's not from the employee. The reason they call it an employer match is the employer cuts a check. And let's say you make 100 grand and they're matching 10%, you're getting a $10,000 check from the employer. The employer gets a deduction, it goes into your account, and it's not treated as taxable as long as you keep it traditional. Now, if you convert it to Roth, you're going to show 10,000 of extra income on your 1040. And this does not use up compensation. It does not use up compensation. The employer could have said, my example, we had 23,000 of compensation. We used up 22,500. Let's say I had, so 23,000, they do 10%, they contribute 2,300. I still have $500 of compensation left over to use to apply to making contributions to an IRA or to this 401k under cup number 3, etc. So the employer matches what it sounds like. The employer looks at your salary or your compensation. They pick a percentage, a flat number. It's the same for all employees. It can change from year to year. They cut a check, the money goes into your account. Employer gets a tax deduction, no tax to you unless you convert to Roth, in which case it becomes taxable to you. The third cup that you can pour into your 401k is nicknamed Mega Roth. Now be careful when Googling the term Mega Roth, because older Mega Roth styles or approaches involved converting your Roth 401k to a Roth IRA. That is now obsolete. So let me repeat that. If you're going to go Google Mega Roth, older versions of Mega Roth involved converting your Roth 401k to a Roth IRA. You no longer have to do that. There have been some good changes in the law that the newer, better form of Mega Roth is basically, here's the technical version for the CPA types. You make a contribution, it has to come out of compensation. So in my example, we only have $500 left for Mega Roth. So that person, if they want to fill the bucket of the 401k, they need to increase their compensation. Right now, they don't have enough. The 23 grand isn't going to cut it. Assuming you have enough compensation, you can fill the bucket. Mega Roth uses up compensation the same way the elective deferral, AKA cup number 1, uses up compensation. Now, why do we call it Mega Roth? Technically, it's an after-tax contribution to your 401k, traditional after-tax contribution, so no deduction, that is immediately converted to Roth. Functionally, it's a direct contribution from your salary or compensation straight into the Roth portion of your 401k. That's why we call it Mega Roth. Now, your plan document has to allow for 2 and 3. 2 and 3 are not automatic. The plan documents have to allow it. And in particular with Mega Roth, a lot of plan documents don't permit it. So I thought this would be a useful intro because a lot of the changes in Secure 2.0 involve changing these numbers, and all for the better. All of these changes are for the better. In fact, they're so good, I'm just going to have another nice little sip. This, by the way, for the bourbon enthusiasts, this is Rebel 10-year, so an aged wheated bourbon. Makes me happy. Makes me real happy, actually, once I've had a bit. That's just a wee little bit. All right, so we have catch-up contributions. Old people, 50 or older, which I'm 53, so here we are. Old people, 50 or older, get 75 grand, or not 75, 7,500, sorry, 7,500 more. I call it the catch-up contribution, and to make it memorable, well, I might have messed with the spelling there a little. So if you look at the contributions here, normies, young people, under 50, get 66,000 in the 401k bucket per year. Add 7,500 to that, and it's going to be 73,500, right? The bucket is larger, as is cup number one. Cup number one also goes up by 7,500. So for 2023, if you're 50 or older, you get $30,000 for cup number one, and your bucket is 73,500. So the bucket for old people, this is again normal catch-up contributions. This is all pre-Secure Act 2.0. Now, what did Secure Act 2.0 do? It's going to give you some supersized extra catch-up contributions. So I'll go through this quickly because it's pretty simple. I actually spent a lot of time building up to it, but it's good. I think a lot of you listening to this probably didn't know about all the contribution alternatives for 401ks and how to fill that bucket with those three cups. So what did the law change? It said any year starting in 2025, so this doesn't start till 2025, but if in 2025 or any later year, you're 60, 61, 62, or 63, you get a supersized catch-up contribution, meaning you could put more in if you want. Your total catch-up contribution is, for those years that you qualify, $10,000 or 150% of the then existing normal catch-up contribution, whichever is greater. Well, the present catch-up contribution is 7,500, and I don't think it's going to get any smaller. 150% of that is 11,250, which is greater than 10,000. So more likely than not, in a 401k plan, your catch-up contribution is going to be 11,250. Now, they also did something like this for simple and set plans. I didn't bother to put it in the slide. Why? If you're using a simple or a set, it's 99% likely you should change that plan to a 401k, particularly if you're self-directing, because as we mentioned, 401ks are superior. Consequently, I mostly ignore SEPs or simples. And when I run into clients who have them, when we do planning work for someone who has those accounts, we ask why. And usually the answer is my CPA said so, and we don't have any really good reason. And then we say, oh, you probably should convert over to a 401k, and they usually do. However, catch-up contributions for rich people are different. And this is funny. Actually, it's very rich. So starting in 2024, catch-up contributions to 401k, 403b, 457 plans by employees whose wages exceed 145,000, and that is going to be indexed for inflation, must be made on a Roth basis. So if you're going to do catch-up contributions for 2024 onward, and your salary is 145 grand for that company, because 401ks are tied to a sponsor, to a company. Remember, you can have more than one 401k, which implies you can work for more than one company. For years in which your catch-up contribution is 145,000, or sorry, your salary is 145,000 or more for that company, your catch-up contributions have to be made on a Roth basis. Why did they do this? Why are they forcing Roth on people who make too much? Because of government budgeting. In order to pass this bill, they have to pretend, both parties do this, that it's revenue neutral. And to do that, by forcing you to do Roth, the government actually shows more revenue now and a lot less revenue later. You know, given that most of the time, Roth is better than traditional for most of the people listening to this call. In other words, if you're pretty good at investing, and particularly if you're pretty good at investing and you're in an inflationary environment, Roths are better than traditionals, and there are some techniques to convert to Roth that reduces the pain of the conversion. This is interesting because they're forcing you to do Roth if you make more than a certain amount. Here's what makes this rich for me, the contradiction. Because with a Roth IRA, if you make too much, you're not allowed to directly contribute to a Roth IRA. In other words, Congress was thinking contributing to a Roth IRA if you're rich is bad. And here they're saying if you have a 401k and you're older, 50 or older, and you're making extra contributions and you make too much, you must make Roth contributions. It's good. Congress. I can't even say gotta love them, because frankly, we don't. It's this kind of stuff that makes you really want to just hate them. But oh well. So couple of issues. Take a look at bullet point number 4. Applies to the prior year wages. So only wages from the employer sponsoring the plan. So prior year wages, which leads to some interesting planning opportunities. For example, if you started at an employer last year in the middle of the year and you contributed to their 401k, but you only got paid wages for half the year and ended up being less than 145 for the half of the year, this doesn't apply to you. This only applies to W-2 employees. So for those of you whose compensation comes from a sole proprietorship, a Schedule C, a single member LLC, a multiple member LLC, then this rule doesn't really apply to you at all. Here's a catch. Watch out for this. If the plan docs do not allow for 401k Roth, this is really important. This is probably not intended, but it's how it worked out. If the plan docs do not allow for a 401k Roth, then no one can make any catch-up contributions. Why? Because if someone's paid 145 or more, they're not able to make Roth contributions, but the law requires them to make Roth contributions, and therefore no one is allowed to make catch-up contributions. So what's this mean? If you don't have something in the plan doc that says your 401k allows Roth, and at this point, most of them do. I think there are a few older plans out there that maybe don't, but most plans do allow for both traditional and Roth in the 401k. But if the plan does not allow for Roth, then you're not allowed to have the catch-up contributions, meaning older people, those of us who are 50 and older, are bound by the same contribution limits as younger people. You don't get the catch-up contributions. This does not apply to most of you. It may apply at your job if you have a regular W-2 job, so you got to watch out for it. It shouldn't apply to most of you, but I thought I'd mention it because it's a pretty big deal. There is required auto enrollment. The government has done studies, and God knows studies never lie. I mean, except when you structure them to say exactly what it is you want them to say. But anyway, nobody would ever do that. The government studies in social engineering, that is how to control you because you're too stupid to do anything for yourself. And the government, which is full of really good people, just ask them, who know much more than you because you're dumb and they're smart, have decided that for social engineering, if they require automatic contributions to a 401k that you're allowed to turn off, a certain percentage you will be too stupid to turn it off, and you will save more for retirement. Now, we'll go through this and I'll tell you what will really happen. So the theory of the government is, if we force you to save into your 401k with the option of turning off the forced savings, some of you will accidentally save for retirement. And so that's the social engineering. That's why they're making this happen. I'll tell you what the real result will be in a minute. So auto enrollment, there's going to be a requirement. Now, the exceptions are at the top. The auto enrollment is the last bullet point. It won't apply to most of you. It starts at 3 to 10% of the employee's compensation, W-2 for most of you, per year in the first year. It automatically gets withheld from the compensation, from the W-2, and dropped into the 401k. It goes up automatically 1% a year, up to a 10% maximum. And then from certain years and for certain types of plans, it'll actually be a 15% maximum. The employee can opt out or change the amount at any time. So there's the theory. We are going to start withholding and hope you don't notice. But if you do, you can opt out. But some of you won't notice. And so you're going to be tricked, fooled into saving where you would not have otherwise saved. Let me tell you what's really going to happen. The people who would not save in a 401k will be tricked into saving for a while until they notice. And then what are they going to do? First, they're going to stop, but then what are they going to do? I will bet you dimes to dollars, a lot of them will distribute the money that they were tricked into saving, that they were forced to save until they opted out or until they noticed that they were being forced to save. And they're going to pay taxes and they're going to pay penalties. I predict that the very people this was designed to help, it's probably going to hurt. Now, thankfully, it does not directly apply to most of you. Those of you who work for a normal W-2 job, you may see this hit at some point, but it only applies to new employer plans. It starts in 2025. It only applies to 401ks and similar types of plans, not to IRAs. There are exceptions for existing plans, new businesses, and small businesses, and that's why this probably won't apply to most of you. Existing plans are grandfathered, but when the plans, sometimes you do a complete revamp or move to a new plan supplier, a new plan administrator, then you may have a quote unquote new plan. If you are new, so new is you've been in existence for less than 3 years, then this doesn't apply to you. Bear in mind, the government looks at not just because some of you are like right away, I know what I'll do. I'll always be new. I'll have an LLC for 3 years. I'll shut it down and set up a new one. And I'll just continue along. And I'll do that every 3 years. And that way I'll always be new. Guys, the government looks through that, right? They're going to see what you're doing. They treat similar companies as one. This is the controlled group rules. Commonly owned companies. Here's the classic. I have 50 employees in my construction company, none in my rental management company. I'm going to set up a sweet plan in my rental company and exclude the 50 employees in the construction company. So I can give myself a nice plan and have all these little benefits, and that I don't have to give it to the employees. Well, the government says, yeah, actually you do. They have something called the controlled group rules, and I'm summarizing in a really crude manner here, that if you have common ownership of 50% or more between entities, and that's including, by the way, your spouse is treated just like you, et cetera. If you have common ownership between entities, then it's treated as one entity. So even though you have a construction company with employees, a management company, in my example, with no employees, you set up a bunch of fun things here, 401ks and health reimbursement accounts and all. Under the controlled group rules, if you own both companies, 50% or more, directly or indirectly, it doesn't matter if you use trusts or you put it in your cousin's name or your dog's name or your spouse's name or whatever, these are treated as one company. And so the employees over here have to get the same benefits you are providing over there. So coming back to this, the scheme of having a new entity every 3 years isn't going to work. The exception most of you will rely on for the business people here, a lot of you have 10 or fewer regular employees. So if you normally employ what I call regular, if you have fewer than 11 regular employees, this doesn't apply to you, but it applies to your whole controlled group. In other words, if you have two different entities that you own 100% of, one of them has 5 employees and the other one has 9 employees, you're over the limit of 11. They're just going to add the employees up from the different entities. So again, having separate entities here normally will not make a difference. Once you have 11 or more regular employees, these rules now apply to you unless you have an existing plan, in which case it's grandfathered, or if you're new, it doesn't apply for the first 3 years. So just be aware of that. It's out there. Student loan payments may count for match. Do you remember cup number 2? Cup number 2 is when you have salary and the employer matches it. So maybe they match it 10%. I have a $50,000 salary, they match 10%, they stick $5,000 in my 401k, yay me. Well, now I'm going to get a little more subtle about how these plans can work. There is a type of 401k plan. You can have a self-directed 401k plan and have employees. You're not allowed to have a solo 401k plan and have employees, right? The only employees can be you and your spouse if you have a solo K, otherwise you don't qualify. Can you still have a self-directed 401k plan even though you have employees? Sure. The most common route, without getting into crazy details, the most common way to do that is a custom-made safe harbor plan. Safe harbor plan. How do those work? Well, the IRS says, listen, we'll let you do this, and it'll be a cheapish plan, not as cheap as a solo, but cheapish, if you agree to do one of 2 things. You have to contribute 3% to every employee's salary, 3% to every employee's salary, or you have to contribute a minimum of 4% to every employee's salary, but only for employees who actually contribute, only for employees who actually contribute to the 401k. And a lot of people take option number 2. It's cheaper. Why? Let's say you have a bunch of fairly low paid employees. They do not tend to contribute to 401ks for a variety of reasons. So you have a bunch of low paid employees. You could match 3% of everybody, their whole salary combined, or you could match 4%, but only of those who contribute. And you know most of them won't contribute. Well, when you do the math, 4%, but only to those who contribute to their plans, turns out to be a lot cheaper. Now, what this says is that if you want, this is optional, this is not forced upon you. This is if you want to attract young talent. So after the universities have ripped off a bunch of students because Marxist socialist professors are Marxist socialists with other people's money, but not with their own money. They charge as much as they can get away with. They ruthlessly exploit teaching assistants. They charge whatever they can get, and they don't warn you, for example, that maybe your underwater basket weaving degree or other degree isn't going to earn you enough to pay the massive student loans that fund their lifestyles. So we have a student loan crisis in the country, a lot larger university crisis, but that's a part of it. So this is a sort of an odd response to it. What it says is a lot of people with huge student debt would love to contribute salary to their 401k, but they don't. Why? Because they're busy in indentured servitude, paying off their kind and caring professors. And so they cannot contribute to the 401k. They don't have enough leftover money to do it. And so what this law says is if the employer wants, the amount of money an employee paid towards student loans can count as a salary for matching purposes. Let me repeat that. If the company wants, if they want to include it in their plan document, the amount that someone is paying towards student debt can count as salary solely for the purposes of calculating cup number 2. In other words, you didn't put any money into your plan. Normally we wouldn't match, but we're going to allow you to pretend your student debt was a contribution. And so now we are going to match. We are going to contribute to your 401k plan. That's all that this really means. So an example, take a look at the bottom, 4th bullet point, employee contributes $3,000 to the plan and has, I better start the bullet point ahead of that. An employee, okay, I did a lousy job on that. We should edit this out. Very basic example, employer matches 4% of salary, but only to the extent the employee contributes to the plan. In such cases, the match is 50% of contributions or 4% of salary, whichever's less. So the employee contributes 0 to the plan and has a $50,000 salary. The match is the lesser of 50% of the contributions or 4%, so 0 because they didn't contribute anything. Employee contributes $3,000 to the plan and has a $50,000 salary. The match is lesser of 50,000 of $3,000, the amount contributed, or 1,500, or 4% of the salary, 2,000. The smaller number is 1,500. Now let's change it. Instead of the employee contributing 3,000 from salary, they made $3,000 in student loan payments. If the plan permits, we get the same result. $1,500 employer match to the plan. So that's it. Pretty simple. Once you think about it, pretty simple. It just takes a minute. There's a context here. All right, this is, I'll be brief on this one. More options for the spouse when inheriting. I could have put after that, I don't know, when inheriting. Surviving spouse may step into the shoes of a deceased spouse. Now, you don't always want to do this. This has to do with inherited IRAs. And 401ks, by the way, do convert into inherited IRAs. What happens? What does it mean that the surviving spouse can step into the shoes of the deceased spouse? Here's what this means. The surviving spouse, if they choose to step into the shoes of the deceased spouse, uses the deceased spouse's age to do RMDs. Now, this makes sense if the spouse who's deceased, the one who passed away, if that one was younger. I am 60, my spouse passes away at 55. I can now be treated as my spouse or as me. Well, my spouse was 55 when she passed, and I was 60. Would I rather distribute sooner or later? Later. So I will take the option to be treated as my deceased spouse for the inherited account, 55 years of age. That gives me an extra 5 years before I actually have to make required minimum distributions. I also get to use a better table without going into horrid detail. There are better tables and worse tables for calculating required minimum distributions. If I choose to step into my spouse's shoes, I get to use the better table. Now, here's a real oddity, number 3, and I don't see how you can plan for this, like tripping over somebody's life support plug or something, maybe, but I don't really see how otherwise you can plan on this. If the surviving spouse dies before required minimum distributions begin, then beneficiaries are treated as original beneficiaries, meaning no 10-year rule. Let me give you some context. If you inherited a retirement account and it converted to an IRA or was originally an IRA prior to 2020, so let's say I pass away, my 8-year-old granddaughter inherits my Roth IRA. She used her 8-year-old lifetime, which presumably you can add 100 years to make required minimum distributions. It was very beneficial for her to use her lifetime since she was so young. Well, Congress came along with Secure Act 1.0 and said, listen, if you inherit a retirement account 2020 or later, you have to distribute the whole account within 10 years. In other words, no more of this 8-year-olds inheriting and sitting on an account for 60 to 100 years and distributing teeny tiny little bits over that very long period of time. They said, nope, you're going to have the 10-year rule where you have to distribute everything within 10 years. So inherited accounts that were inherited before 2020 are much more valuable because you could stretch, and that's their nickname, stretch IRAs. You could stretch the distribution over a very long period of time. That went away in 2020. Inherited accounts are now, with this exception, have a 10-year lifespan. I pass away, my 8-year-old inherits. Technically, we don't start distributions until 10 years after she hits the age of majority. So in the case of a minor, once she hits 18, 21 in some states, add 10 years, that's how long we have to hold on to the account. Now let's say somebody over 18 inherits. So there's an inherited IRA for a 30-year-old. They have 10 years. They have 10 years with that inherited account before they have to distribute everything. And here's an exception to the rule, the third bullet point. So once again, if the surviving spouse dies before RMDs begin, so going back to my example, I'm 60, my spouse passes away at 55, and then before I start taking required minimum distributions based on the age of 55, I die. The kids inherit, and there's no 10-year rule, meaning my kids inherit a true stretch IRA that is based on their lifetime instead of 10 years. I think that was unintentional. I don't know that there's any great move to change it because it's going to apply to so few people. I mean, how do you engineer for this to happen, right? We stick mom or dad out on the ice floe and let them float away. We trip over the life support drug, I'm sure it'll be some sort of documentary. You make it up, but then, people. Qualified charitable distributions, that's a QCD, qualified charitable distributions. This is important even if you're not anywhere near the age of 70 and a half. So you really want to pay attention to this because it affects how much of your plans you will convert to Roth. The general rule is convert to Roth. It's a good idea. However, there's an exception to the rule, and it's driven based on your plans for later charitable giving. So what's a qualified charitable distribution? Once you hit the age of 70 and a half, you are permitted once per year to give up to $100,000 per traditional IRA. Let me repeat that. Once you hit the age of 70 and a half, you are permitted straight from the IRA. You don't make a distribution. The IRA cuts a check to a charity for up to $100,000. Now, why would you do this? Well, only if you planned on giving to charity to begin with, right? If you have no plans on doing that, you can just fast forward on the presentation, assuming it allows you to do that. I hope it does. But if you plan on giving to charity, and in particular for my tithers and the people who plan to give quite a lot, people with a lot of gratitude and who intend to do something with that sense of gratitude, this is a very important planning technique. What happens? If your traditional IRA gives 100 to charity, it applies towards your required minimum distributions. So it will be treated as if you had made the required minimum distribution to yourself, but it is not taxable. In other words, it's treated like a Roth. Let me repeat that. You give 100 grand or less from a traditional IRA to charity, straight from the IRA. You don't distribute and then cut a check. You do it straight from the IRA. It's not taxed. In other words, it's treated as a Roth distribution, but it still counts towards your required minimum distributions. So it's an excellent, excellent way. It's probably, in my opinion, the preferred way to give to charity in your later years. Now, if you're going to do that, then you want to make sure to not over-convert to Roth. There's a cost to converting to Roth. And that cost is that when you convert from traditional to Roth, the conversion amount gets included on your 1040. Well, if you're not going to use all the Roths, in other words, if you're going to fund, you're going to keep a traditional because you're going to give a lot to charity later, keep the traditional. Don't pay the cost to convert. Think ahead of time. John, I like this tax break. I do, for example, tithe. So if I can fund contributions once I turn 70 and a half to my church to the tune of 100 a year per spouse, I'm going to do that as much as I can. Great. Then you need to sit and plan how much will be in your accounts. And I get it. There's some guesswork involved. And don't convert to Roth to the extent you want to keep the traditional funded to be able to do this sort of thing. Now, the legislation indexes the 100 grand. The 100 grand that you're allowed to contribute to charity didn't used to change. Now it does. It's indexed to inflation starting in 2024, which is good. It also allows $50,000 per traditional IRA, so 100 grand once per lifetime for spouses, to go to a charitable remainder trust, a CRT, charitable remainder trust. Here's the problem with that. That's a tiny number. I mean, if you look at the cost of setting up a charitable remainder trust, funding it with just 100 grand makes no sense at all. And the legislation, unfortunately, says you can't mix this money with other money. If you're going to fund a CRT, in other words, you're going to do it with this money. So I don't think that last little piece is practical. I thought I'd mention it, and those who see it that get excited, you probably want to get unexcited right about now. Qualified disaster distributions, I'm going to be very brief. I don't like them. I don't like 401k loans. I don't like anything that causes you to take distributions or borrow money out of a retirement plan, especially a Roth, ahead of time. Why? Oh, John, this is awesome. I was told I can borrow $50,000 or half my plan asset balance from my 401k, whichever is less. So usually 50 grand. This is awesome. I love to be able to take my 401k money and give it to me. That's so cool. No, it's not. You're taking money out of the tax-free in the case of a Roth, or out of the tax-deferred world in the case of a traditional, and you're bringing it out into your world, the taxable world. So the only way I'm going to do something like borrow from my 401k is if I absolutely have to. But for those of you who have any interest, if you have a principal place of abode, that's where you primarily live, within a federally declared disaster area, like anywhere a Chinese balloon might fly and spy, we don't shoot it down for some odd reason until after it's done all of its work and transmitted it back. But anyway, neither here nor there. You can take a distribution up to 180 days after the declaration date of the disaster. You report the income from the distribution either all at once or spread out over 3 years. And if you pay the money back by the end of year 3 to the account, then it's not taxable. Of course, you have to go back and amend the returns. Now, the amount's only 22 grand. The amount's only 22 grand, and it is per controlled group, is the way I read the statute, not per entity. So you can't set up 3 entities and have 3 401ks and then take 22 from each. No, you would actually have to have several controlled groups. And I mentioned those before. It's multiple entities that are treated as one based on common ownership. Here's the issue: size matters. If you're going to do this, which I really don't like it, but let's say you have to. 22 grand, it's not a lot. I guess if you're going to take it out, it's nice that you pay the tax over 3 years. But in terms of putting it back and amending for having 22 grand for 3 years, the cost of amending returns, I don't know that that's a really good deal. So I'm not really excited about this. I thought I'd mention it. 10% penalty exceptions. This is really important. We see court cases all the time where people see a 10% penalty exception and think that they think that means money comes out of their IRA or 401k tax-free. It doesn't. It doesn't. It just means you don't pay the 10% penalty for being under the age of 59 and a half, but you still pay the tax for a premature distribution. So for example, domestic abuse, you can take up to 50% of the plan balance or 10 grand, whichever is less. You have to self-certify as having been domestically abused. Be careful, that may have other implications, right? That could be discoverable. If you say you've been abused, that has implications if somebody comes later and says, yeah, I want those documents that pertain to such and such abusing you for, maybe prosecution or litigation purposes. So you gotta be careful what you say about people. The withdrawal has to be within a year of the domestic abuse incident. You have 3 years to pay it back, and it's 2024 or later. Now, again, let's look at the rest of this. Terminal illness. Physician says you have some illness or physical condition. I joke married to a Latina because I am. And here in Puerto Rico, I mean, yeah, that's something that will kill you within 7 years. So I did warn you this was not politically correct. I don't do that. Physician says you have some illness or physical condition that will kill you within 7 years. And there's no real limit on that. You get a doctor to say, you've got this thing, it's going to kill you within 7 years. You can withdraw whatever you want without paying the 10% penalty exception from your 401k or IRA. And look, if it's true, if you really are dying and you need access to the money, it's great to not pay the 10% penalty. However, remember, you still pay the tax. If it's a traditional account, you pay the tax. If it's an unseasoned Roth, you pay the tax, the income tax. You're just exempt from the premature withdrawal penalty of 10%. They're allowing emergency withdrawals of $1,000. That's such a small amount. I don't care. I don't even want to take the time to describe it. You should know it's out there. If you want, Google it. I think it's just pointless. Long-term care premiums. You are allowed to withdraw from the 401k. Again, not tax-free, just 10% penalty-free for the lesser of 10% of the account balance or $2,500. So if you really don't have any other way to pay for your long-term care premiums, I suppose this is the way to do it. But I think you have to be pretty desperate to do that. Things have to be pretty bad. I hope they're not, truly, sincerely. Big disaster loans. Again, I'm not a fan. I don't like pulling money from 401ks, right? If there's any other way. But some people look at this as an opportunity. Hey, my principal abode in declared federal disaster area means I can borrow up to 100% of my plan balance or 100 grand, whichever is less. And I have an extra year to repay it, which usually means about 6 years. So I'm in a disaster area, federally declared. It automatically means I can borrow 100 grand if I have that much in the account. And instead of 5 years, I have 6 years to repay it. I don't get excited about that. I don't like pulling money out of a tax-free or tax-deferred place and bringing it into the taxable world. Now, if you truly need the money, I guess this is a good option to have if you well and truly need it. That's really the only way I would do this. This is important. Change in definition of part-time. You now have to include, you always have had to include people who work a certain number of hours. And what you used to do, so that the first rule used to be 1,000 hours per year per employee. Otherwise, you could legally discriminate. You could put in your plan docs under the old rules, and you still can sort of, we'll get into that you have to work at least 1,000 hours per year or you don't qualify for the 401k. And it was a way of excluding employees from coverage. So you didn't have to, for example, match their salary. Well, Congress with Secure Act 1.0 said, yeah, we're going to say that if someone works 500 hours for 3 years in a row, they qualify starting in 2024. In other words, if they work 500 hours in 2022, 500 hours in 2023, and they hit another 500 hours in 2024, you have to include them in the plan doc in 2024. 500 hours. So it dropped the number. Let's call it longer term part-time. So instead of 1,000 hours, that's 500 hours per year. But if they were with you 3 years, you had to include them. Well, Secure Act 2.0 changes the 3 years to 2 years. So if you got somebody working more than 500 hours 2 years in a row, you got to include them in the plan. Be aware of that. Also, take a look at bullet point number 2. Be careful not to self-exclude. We saw some people put in the 1,000 hours requirement in their plan docs so they could exclude anyone who works less than 1,000 hours, and then they worked less than 1,000 hours. Oopsie, not part of the plan. The saver's credit was and remains rare. I'll go through this very briefly. I want you aware of it. A lot of people make a big deal out of it. In practice, we rarely see it used. The saver's credit was and remains rare. Why? First of all, so if you contribute to any of these plans up to $2,000 qualifying contribution, some percentage of that contribution became a credit. Some percentage of that up to $2,000 contribution became a tax credit. What's the problem? First of all, if you're under 18, forget it, doesn't work. So it doesn't work for your kids. If you're dependent on someone else's return, for example, students, that doesn't work. In fact, it says if you're a student with a really broad definition of what's a student, you don't get this credit. So all the people you would normally think of like, hey, I'll give my kids money and they contribute to their IRA or 401k and they get this credit. All of this stuff here makes that a no-go. Given all these restrictions, and by the way, we'll show you on the next slide, you also have to be pretty low income for this to apply. Once you start making any significant money at all, this credit just doesn't apply. So we just don't see it. You know, I hear the accountants, oh yeah, we want to use this for planning. Find someone for whom it works. It's rare. They're under 18, they're not dependent, they're not a student, and you'll see on the next slide, they don't make much. Okay, great, take it. Now, where I did see some planning opportunities, people, elderly parents, elderly family members, maybe working part-time, you know, the Walmart greeter or whatever, and there it would make sense for them to contribute to one of these. Maybe you even gift them money so they can afford to contribute to one and they get some sort of federal credit. That's where I've seen this actually function. Non-dependent retirees, final bullet point. Here are the income thresholds. So if you go through adjusted gross income, that's your AGI. If your adjusted gross income, if you're married filing jointly, is not more than $43,500, which isn't a lot for married filing jointly, then half your contribution. So $2,000 contribution max, up to $1,000 credit. So, okay, that's nice. How many people actually qualify? Very darned few. And then if you take a look as they make more money, when they make between $43,500 and $47,500, only 20% of the contribution counts, and so on. So bottom line, everybody likes to make a big deal out of this credit. I don't think it's that big of a deal. They have a similar sort of credit replacing it in 2027. I didn't bother to go through it. There is a federal match that's replacing this in 2027. Well, A, it's in 2027. Let's see what happens between now and then. B, it's got pretty much the same limitations. So the fact that they changed it from a credit on your return to a federal matching grant means a few more people will be eligible for reasons I won't go into. But still, based on all these restrictions, age, student status, dependent status, low income, I just don't think a lot of people are going to qualify for this. I would focus, to the extent you're going to use this, on older relatives who have a small amount or maybe can be provided a small amount of compensation to contribute to their plans where they can at least pick up something of a credit. All right, miscellany. So we're closing up here. I know it's been a lot. Guys, I shaved so much off of this to try and keep it relevant. But let's get into the miscellany and close it up. Simple and SEP employee and employer contributions may now be Roth. So again, I don't really get into simples and SEPs. I think they're generically, and I'm generalizing. Maybe there are a few specific circumstances where a simple or SEP really is better for you than a 401k. I would generally say it's not the case. Simple and SEPs have been purely traditional. They are now allowed to be Roth. Great. IRA catch-up contributions. So this year, normal people, 50 and under, youngsters, can contribute $6,500 to their IRA per year per person, assuming they have enough compensation. Well, if you're old, like me, 50 or older, then it's 1,000 extra. Well, they're going to start indexing that 1,000 to inflation starting in 2024. Great. More cowbell. That's a reference for old people. If you're under 35, Google. It's back when Saturday Night Live was funny. Yes, there was such a time. It did happen. I was there. So more cowbell, definitely worth Googling if you're culturally far too, I wouldn't say behind the times, that's me. I guess if you're what, ahead of the times? But matching contributions, cup number 2, if you go back to that all-important slide on contributing to the 401k, cup number 2 may also be Roth. It doesn't have to be traditional. They came up with this concept of a starter 401k, and from what I can tell, it's just inferior. For most of you, especially if you qualify for a solo 401k, just go for that. If you have employees and you want to self-direct, probably you're going to use a self-directed safe harbor plan. But this whole starter 401k, it didn't do much for me. It's an easier but also diluted 401k, not diluted. That would be referring to certain other people who rule over us, whom I won't mention. That's diluted is what I was saying. Oh, enabling procrastination is important. Sole proprietors are now allowed to establish 401k plans for a given year before the unextended, that's important, unextended due date of the return. So for those of you who want to establish a solo K plan, if you have a sole proprietor, you're filing on form, let's see, Schedule C of Form 1040, and you want to establish and contribute to a 401k for 2022, you can do it. You can do it up until April 15th, kind of like with IRAs, right? With IRAs and health savings accounts and Coverdale accounts, you can contribute for 2022 up to April 15th of 2023. Well, now they're saying if you're a sole proprietor, you can set up a solo K. So not just contribute to, but even set up the solo K in 2023 up till April 15th and contribute to it for 2022. And that's okay. So we are going to have a follow-up to this. There'll be some Q&A. Hopefully this was useful to you. If you want to get a hold of us, there's the contact information. I do client work, but it's only about 2 hours a day. It's a small office, me and one other employee. I'm not cheap. I bill $1,000 an hour. I do an awful lot of planning work. I save people stupid amounts of money, but there's only one of me and my hours are limited. And if you take a look at taxreductionlawyer.com, some of our educational offerings, including the ability to talk to me monthly, will be out there. I hope you learned something. I don't know that enjoy is ever really the term. I mean, if you enjoyed this, there's probably something horribly wrong with you. But hopefully it was quick enough, entertaining enough, but we still got you the vital points that are helpful to you so you understand what Secure Act 2.0 is all about. I wish you the best in your self-directed investing. I hope you get a ton of Roth money, and I hope you pull a Peter Thiel and turn your $2,000 Roth contribution into a $5 billion Roth. Yes, that is what he did. I hope you do the same. Take care.